Hi, podcast listener. Welcome to Truth About Exits, a show dedicated to pulling back the curtain to reveal what it really takes to get deals closed. You'll hear directly from founders of companies who have raised capital, sold their companies, and even those who acquire other companies for growth. I'm your host, Corin Woodmass. I'm a deal maker, advisor, and when I'm not closing deals, I love to talk to others about their deals and what it took to get them closed. And now you can listen into these conversations too. For all the show notes and more resources, go to truthaboutexits.com. And we're live. Today on Truth About Exits, I'm joined by Brien Davis. Brien's a partner at Altacrest Capital. He and his partners have completed over $3 billion worth of investments during their 20-plus year careers. Today, we'll be talking about their acquisition of Barton Watch Bands, an Austin-based e-commerce company. Brien, thanks for joining us here on Truth About Exits.
Thanks for having me. Pleasure to be here.
Awesome. So we met while we were marketing an e-commerce deal recently, and we had the good opportunity to catch up while you were in Austin for lunch. So I got to know you a little bit then, and I'd like to introduce you to the listeners. So before Altacrest, what were you doing before launching Altacrest? And we'll jump into what that is in a minute.
Sure. No, thanks. So Altacrest Capital is a little over a year old. As we like to say, Altacrest is fairly young, but unfortunately we're not. I've got two partners. There's three of us in total. Two of us worked at Prudential Capital Group for about 15 years together, Tim Lachkowski and I. And prior to working at Prudential Capital, I spent about 5 years in investment banking, doing mergers and acquisitions as well as capital raises and things of that nature. But the majority of my career, as I mentioned, is at Prudential Capital Group. And Prudential Capital Group basically invests the money of Prudential into middle market companies. You know, everybody's got a different definition of what middle market is. At Prudential, it was getting a little bit larger in terms of deal size relative to when I started in 2004 versus when I left in 2018. So we typically looked at transactions at Prudential Capital that would have EBITDA really anywhere from about $7 million up to a couple $100 million. And so, one of the things that led Tim and I to want to start Altacrest was, as we looked at companies that were smaller, they would come across through our deal networks and different, intermediaries we knew, different friends, different companies that we had called on. We saw a lot of really attractive companies that were, a couple $1 million of EBITDA up to $10 million. And as the market, started to go away from companies that size and large financial services firms such as Prudential Capital were putting bigger and bigger sums of money to work in larger companies, we felt like there was a need there. And so, we used to invest capital in a wide variety of industries, anything from consumer products to business services to manufacturing and things of that nature. But both Tim and I really wanted to have a tighter industry focus. We both liked consumer products quite a bit. And a good friend of ours, Rick Sukar, is our third partner, spent the vast majority of his career in consumer products. He spent about 15 years with JP Morgan, primarily in their M&A group, helping to sell, large consumer product companies. He got tired of the larger financial institution arena, and in 2008 went out and started to operate companies, and the last of which was a consumer product company. It was private equity owned, that they really started from startup and grew from there to about $15-20 million of revenue. And they really used e-commerce as an important platform to not only grow sales on e-commerce, but also in terms of getting into other sales channels as well. And so, as the three of us were talking and had similar interests and similar areas of our career. We wanted to do something more entrepreneurial. Altacrest seemed like a great idea, and we've been fine-tuning the strategy ever since, but are really spending the majority of our time now focused pretty tightly in on consumer product companies that are either selling primarily through e-commerce or existing, what I would call, more old school consumer product companies that have perhaps a poor online strategy, and something where we can, take that and introduce direct to consumer, et cetera, to help them grow and, really give, the consumer what, the products where they want them and how they want to buy them is sort of our focus.
Absolutely. And I've seen a trend. I've just recently moved to the US myself, and I've noticed a trend here. I'd noticed it from afar before, but it's more evident here once you're living in the States or spending more time in the States, is people actually, it seems to be a huge trend of the average person to care about where they get their products from, and they want a brand story, and they want to talk about the products they buy to all of their friends, which is great if you've got a good product to sell, but not so great if you're a legacy type large brand. So are you seeing a similar trend in consumer behavior?
I think absolutely. I think that, most people, although we like to think we act logically, most people make actions based on emotion. And I think, at the buying decision, that's clearly there too. And people want to relate to the product they're buying, and they want to hope that it has the same, primary value set that they have, whether it's, all natural type products that are, eco-friendly, which is, one of our areas of focus, and actually where we just closed our recent transaction, or whether it's a brand that they can identify that's, socially conscious. Barton that you mentioned earlier, we have a couple of different situations where we'll have a particular watch band that we sell, and a portion of the sales go to an identified nonprofit organization, and we think that's important, and it's not only important for the brand, but we think it's good for society at large, and so we're happy to jump on that trend as well.
Absolutely. It's nice when trends in the entrepreneurial capitalist industry or focus turn towards helping other people as well. So it's good for marketing, but also good for everyone. So it's a win-win, a true win-win, which is nice. So
Absolutely.
I like the I like the fact that you guys have a tight focus on consumer products, and specifically in e-commerce, because obviously that's what we mostly deal in as well. So how do you look at these businesses? Let's say Barton. So when you first looked at the business, and by the way, you guys move quick, right? You
Right.
only just launched a year ago and you've already done 3 transactions. You guys don't muck around. I like your style.
Try to stay busy.
Absolutely. So you mentioned that you were introduced to Barton through your network. So you obviously have a decent network from all those years at Prudential, but how many deals do you typically look at before making an acquisition, and what was it about this business that made it an acquisition target for you?
Yeah, we do track how many deals we look at. I don't have the numbers in front of me, but it's, in a given year, we'll look at, hundreds of transactions. And then we probably get pretty serious on, I would say, a couple a month. And so call that mid-20s that we get serious on, meaning we're going to put together some form of indication of interest, expressing what, we'd be willing to pay for a company and how we would operate it, et cetera. And then from that funnel, you get down to, maybe 3 or 4 letters of intent that get signed, and hopefully you close all of those, but it generally leads to closing 75 or 80% of those, just depending on what happens in diligence and things of that nature. So it's definitely part of the funnel approach, but the way that we approach it from a marketing standpoint is we like relationships, and we like finding situations where usually there's 1 or 2 degrees of separation between us and a founder, and it's a nice way to provide both people the ability to back check the other, because when you go into these types of transactions, occasionally you're buying 100% of the company and the founder goes away. But oftentimes, especially in deals that we like to do, the founder, is going to retain a degree of ownership in the business going forward. And so it's important for us to have, a good relationship and a good partnership. And, in many ways, it's like a marriage. So oftentimes, sorry, go ahead. Did you want to interject?
Yeah, sorry, Brad. I'd love to dig into that just a little bit more, where the approach that you prefer is to have the founder or the owner of the company retain equity. Can you explain why that's preferable to you, please?
Yeah, there's a number of reasons. One is just alignment of interest. When you're buying somebody's company, and it could be their baby, to use the colloquial phrase, but you don't know everything. You can do as much diligence as you can, but it's hard to know everything, and there's going to be some transition period. And if you've got good economic alignment to where that individual still owns a portion of the company, usually he or she is much more apt to be helpful, and so we think that that's really a good thing too. The other side of it, it's true in Barton. It's also true in our recent transaction for Corganics, where in both those situations, the owner owns a minority percentage of the company, but meaningful minority. They're both, visionary type product people. They are passionate about, either in the case of Barton Watch Bands, or in the case of Corganics, passionate about, natural based personal care products, be it a pain relief cream, or there's some other ones that we're going to be issuing soon. But they're very good at products. What they tend to not be as good at, admittedly, is really the sales and marketing function, and then some of the finance administration function. And so, it can be a very good marriage. We're not product people, but we are good at sales and marketing, and we are good at finance, at least we believe. And so, if that person retains ownership and can still be involved in overseeing a degree of the product development roadmap, that can be a good fit for us.
Okay, excellent. That makes a lot of sense. And we do come across a lot of founders that are more artisanal types, where they're just super excited about their product, and maybe you're, like you said, not so great on the sales and marketing side, but it's tough to be great at everything. So that creates a pretty good opportunity. So let's talk about Barton specifically. We talked before at lunch, and also before we hit record here, about the timeline on this one. So I'd like to dig into that a little bit. So could you walk us through, you got the initial introduction, you did the kind of background checking to see if it was a good fit. You also mentioned something when you said that in your LOIs, you mentioned how you'll operate the business and what your thoughts are around that, which I thought was really interesting. We often see competitive environments in e-commerce businesses because there is usually no fixed location, or very easy to move locations. So you appeal to a wider buyer pool for the most part. So do you find that that's a competitive advantage to put in your LOI exactly what you're thinking about as far as operationally managing the business and growing the business moving forward?
We do. I mean, I think it's a competitive advantage, and I think it's also just part of our attempt to be transparent up front, and so that we can get everybody on board with how it's going to work. Like in the Barton situation, the founder, who did an amazing job, growing the business to where it was, he did not want to do the day-to-day operations anymore. And so in the letter of intent, it was important for us to outline that, here's the strategy of the type of individual we're going to get to replace you as CEO. We think that the company's, although it's done great in all these areas, here's where we think a few things can be augmented. These are some of the skill sets that we're going to look to bring to bear to do that. And I think it helps, especially in a situation where you're asking an owner to retain some ownership in the company post deal. If he or she gets more excited about the growth prospects and the plan that we're putting in place to achieve that, our proposal is usually deemed more attractive, and I think B, it just demonstrates perhaps a deeper level of thought than some other groups that may just throw a number out there just to see if it sticks.
I like it, Brian. And in the original conversations, you mentioned the intro was in August of 2018, which is last year at the time of recording. Did you find that information out there, or is that fairly boilerplate almost that you put into the LOI what you're planning to do, or do you tailor that to the founder and what their needs are?
We have a pretty standard. It starts typically with an indication of interest. And even in the indication of interest, we may start to outline, a good number of those items in terms of how the operational plan will be, in addition to the economics of the transaction and the structure. The letter of intent then takes it to the next level. Typically the indication of interest is, negotiated back and forth maybe once or twice just to make sure that we're all in the same ballpark with regard to how it would work and economically and operationally. And then the letter of intent is really getting down to, okay, this is what we're going to do. And unless, something pops up in, due diligence that we were unaware of, this is what we're going to close on. And that's important to us to do what we say we're going to do on those aspects. But it's, each situation is a little bit different. We have a standard LOI that we do, but then there are sections within the LOI that are have to be customized for each deal, and that's typically the actual structure of the deal, meaning the capitalization, debt versus equity. Also, the operational plan can be a little bit different because in not every situation are we replacing a CEO. Sometimes the CEO may want to stay on, and we may view that individual as being a great person and somebody that we want to get behind. And so those are the parts that get a little bit more customized.
I like it. And I'm kind of bouncing a little bit back and forward here between the Barton example and just in general, but there's some really interesting pieces of what you just said. So if for instance, a founder is the CEO and what they're really looking for is a capital partner as opposed to a buyout and operational takeover, how do you view that type of deal, and how would you normally structure a deal where the founder is the CEO and they are staying on?
I think that's, it's great. I mean, if the founder is the same person that's going to stay on, because it takes one risk away. Anytime you have a new person coming in to run the show, that opens up transition risk. And that's not something that we take lightly, because we've seen enough situations where a new CEO can be very disruptive, despite your best attempts at interviewing and background checking, et cetera. So, with regard to structure and the way we look at it is, we talked about it earlier, nobody can be great at everything. And one of the biggest things that we see that happens as companies scale is they go from, it's not uncommon, especially in today's world of Amazon, to in your first 3 or 4 years jump up to $5 to $10 million of revenue. And then you start to become, a real company, and you're creating real cash flow, and you're now trying to figure out, how do I scale to 20, 30, 40, $50 million of revenue? And it is a bit different. And part of it is just the blocking and tackling of putting in the process and the people to make it all work. And some of the CEOs we deal with have that skill set. Some of them, are more just visionaries and need that to be augmented. So anytime you're going to grow, it's always a people business, and you've got to think about what you're going to put in there in terms of augmenting the existing capability. So, it doesn't have to be a new CEO. It could be a new, chief operating officer, or it could be a new head of product development that's just going to oversee, vendor management, that sort of, the supply chain. It's really just doing an analysis around, where are the weaknesses, where are the choke points going to be as we grow, and then coming up with a plan for, when you inevitably do hit those, to try to minimize the disruption that it causes.
The most interesting thing to me about what you just said, Brien, is you didn't mention capital once. Oftentimes when I'm talking to founders that are growing at a super fast rate, they think capital is their only problem. But what you just mentioned, and rightly so, is that it's a people business, and people really make the difference. So that's super interesting. So how do you look at the capital side of things when it comes to a founder staying on? Obviously, it depends what they need as well. Do you typically take a minority stake? Do you always want majority? How does that typically work?
For us, we always want a majority ownership position. In my former life, I've done minority equity transactions, and you can do them effectively, but you typically, I'd feel better in larger companies doing minority equity deals than I would in the size that we're dealing at, just because they're more fragile at our size companies are. And so, if things are going awry, we need the ability to step in and try to, implement change if needed. So we tend to like control deals and focus on those. The capital structure question is an interesting one, and that's where you've just you need to have a plan when you get to before you get to closing of, here's what we think is going to happen. Projections are always wrong, but at least gives you an idea of a roadmap of what could happen, and if it does, how much capital do we need to deploy that, and then you take into account, okay, if I need a lot more capital to deploy the growth strategy, I need to put less debt on the business. And we do typically put debt on our acquisitions, but it's what we think is a very prudent level that's not going to choke any growth. But I would say that that's one of the beauties of e-commerce and why we were so attracted to it when we launched is they're very capital efficient, and frankly, as part of our we've got a criteria or a checklist rather of, call it 10 or 15 different attributes of these businesses that we really like. Now, you never check all the boxes, but if you can check a lot of them, that can be good. And one of the things for us is really working capital efficiency. And so as you're growing, how much working capital do you need to maintain and have grow with you, and does that choke off your cash flow? But it's just something you have to balance carefully, and it's something we spend a lot of time on to try to make sure we get right on the front end.
I like it. That's really interesting. Could you share any of your other points on the checklist?
Yeah, I mean, we have certain financial characteristics that we like. Obviously, higher gross margin businesses are obviously favored. In today's world, especially selling on Amazon, you've got to pay your selling commission, as well as we typically do FBA. So I mean, that can be 30 points off revenue right there. So, the higher your gross margin percentage is for your cost of goods sold, it gives you more ability to absorb the Amazon fees or affiliate marketing fees, et cetera, and still have plenty of money for advertising spend and payroll increases that are going to need to occur. So we like that. We like the working capital dynamics I mentioned are important to us. And then it gets into more qualitative ideas, such as we really prefer brands as opposed to just products, and that's a very esoteric distinction between the two. But the biggest thing I think that how you can define that is repeat customers. If you have a lot of repeat customers, I think you're starting to show that you're a brand. Even if you're a very small company, you're getting some brand loyalty by people coming back. And so that's, one of the major areas that we focus on in terms of just some of the analytics that we look at.
And I think Barton would have ticked those boxes for sure. I mean, you can't go to the website and not want to buy more than one thing. If you're a watch guy, you want 4 or 5, or you'll come back. They look like very high quality pieces. So with this deal specifically, with the founder staying on in more of a, well, what does his role day to day look like now that you've acquired and taken over, put in a new CEO into the business?
So, as I mentioned, he still owns a portion of the company. He has a seat on the board of directors. And so, he attends all the board meetings where we discuss strategy and growth plans. He's also, frankly, just a trusted advisor. He a really bright individual. He's a passionate watch person. He's got great product development ideas, and so we tend to run our product development roadmap by him to get his thoughts around it. As a watch connoisseur, what would be liked in the marketplace, and that's he enjoys those parts of the business. But that's and we're still we closed on the transaction last November. New CEO came on early March, so a lot of the transition is over in terms of handing off the day-to-day responsibilities. But there's still a phone call every week or two, just asking some questions and getting some advice, and we appreciate it because he's been a really good partner.
And was part of his reason for selling the business to go do something else? Or was he looking to just pull back from operations and take some time for himself? What was his main motivation in selling the business?
I think all of those. I think, as anybody who's been an operator of a business can tell you, there's a lot of parts of it that are not very glamorous, and it's just a lot of hard work, doing some of the tedious tasks that need to be done to execute well. I think he was a little bit tired of that. I think he wanted to diversify his net worth. He had, built a nice business, 99.5% of his net worth was tied up in that business. And so he was able to get a nice check in our transaction, yet he still owns a portion of it, so that if we're successful in growing it as we hope, he'll get another bite of the apple if and when we ever sell it. And so that was of interest to him. And then I think also, he wanted to do some different entrepreneurial activities. And I don't know exactly what he's focused on right now, but he'd mentioned anything from real estate to all sorts. He's a smart guy with a lot of different interests, so I'm sure he's working through that now to figure out exactly what he wants to do.
Most of our clients mention real estate when they think about diversification. There's something about the online world and real estate that is kind of feels polar opposite. One of my friends builds a lot of affiliate-based websites, and I was at a wedding with him. We were sitting next to each other and we were talking about business back and forth. And he said, I take my fake money when he sells websites and puts it into real assets.
Right.
So I thought that was a funny way to think about it. Obviously, the companies you're acquiring that are real brands and have presence, I wouldn't put in the class of fake money, but yeah, that's a bit of a different thing. But the concept is very interesting to me.
No, it is interesting, and hopefully, we're generating real cash that's going in the bank. Nobody's told me yet if it's fake cash, so
that'd be a problem.
Yeah, absolutely.
So you mentioned bite of the apple, and this is something that a lot of private equity groups talk about as a pitch, basically, to keep the founder engaged and retaining equity moving forward for those reasons you mentioned before, but also to reduce risk. So when you think about a company like Barton, is the main goal to grow and sell, or is it more of a longer term view and see what the best options are at that time?
The good thing is, I mean, our structure is we're not a traditional fund structure that's got a finite life to it, where you've got to sell a business after a certain period of time to return capital back to shareholders. That being said, we're looking to optimize the investment for our shareholders that have put money into this transaction. These businesses are very interesting in that you can grow them. There's a good market to sell them into as they get bigger, because this tends to be the part of consumer land that is growing fast. And so we see a number of folks being active in acquiring them. The other part of these businesses that are really nice is they generate, a lot of good free cash flow if you're, operating them efficiently, and good free cash flow can lead to a lot of dividends and distributions to shareholders. So that's another way to get money back to the shareholders. So, I wouldn't be surprised if we ultimately sold Barton at some point, but right now we're solely focused on growing it and continuing to be efficient in generating cash flow, and we'll see what happens over time.
I like it. And how do you think about risk? So a lot of the companies that we come across, you mentioned Amazon before, it's quite the behemoth of sales and marketing for your business, or for a small brand, and can create a pretty sizable business in a short period of time. So how do you view a business that, say, is majority of their revenue generated through one source like Amazon?
It's a big risk. I mean, there's no doubt about it, but it's one that we think that can be managed. We do think having some diversification is important. A lot of these businesses that may be 100% Amazon, or well over 80% Amazon, we do like to try to diversify their sales channels to a degree. Selling, depending on the type of product, some of them sell very well on their own website. Barton would be a good example of that. And so, to the extent that we can move more revenue to the website, either through affiliate marketing, better use of social media, et cetera, that can be a great thing, and that can help de-risk our reliance on Amazon. And we definitely look to do that. That being said, Amazon, I forget the last stat, but I think they're roughly 50% of e-commerce right now. And so it's hard to get, completely away from them. And frankly, we also think about it from, what does the customer want? Where does the customer want to, buy this product? Do they want to see it on Instagram and just, click and buy it? Do they want to, they're on Amazon anyway, and they want to, buy it there. And so, we're trying to make sure that we're giving a good customer experience such that they want to keep buying them, and we make it easy for them to do that.
I love that approach. That's the first time I've heard someone on the buy side talk about customer experience. That's really important, right? That's what it all boils down to, is who's actually buying the products. And I've had a lot of interesting conversations recently with people that are really negative on retail through their own experience, mind you, either through losing money or barely breaking even on retail channels. But e-commerce worldwide is only about 20% of sales across the board. So there's still a lot of volume that's bought in store. And like you said, go where the customers are. So on top of direct to consumer and obviously Amazon, if that's where the base is, how do you guys look at other channels, specifically retail and wholesale distribution?
I think for most of these young brands, it's important to build up your presence online, either direct to consumer or through Amazon, and to do it in a very profitable way, such that you can survive and thrive without big box retailers or whatever channel of retailer that you need to go through on the brick and mortar side. I think a lot of what gets companies in trouble, especially when they're small and young, is the allure of the Walmart sale, or the allure of CVS coming in, and you can find yourself with a large customer concentration. You can find yourself bidding it down to a margin level that you think's acceptable, but then you get nickeled and dimed and it gets really low. We just like to do whatever we can to de-risk that by having strength in your online areas, your e-commerce areas, D2C, DTC, or Amazon. That way, it's just a different conversation, when you're talking to the brick and mortar retailers, and it's not as one-sided in terms of I'll put you in, 500 Target stores, and now your whole existence is beholden to maintaining that Target order and hoping in 3 months that they re-up and order more. The other part of it is, I think, obviously you lose, the data when you're going through brick and mortar. And I think for a young consumer brand, one of the keys is to be really good at your targeted marketing so that your return on ad spend's really good. And it's just harder to do that when you don't own the end customer through. So we think that, it's a great place to go eventually. Brick and mortar is, and traditional wholesale distribution. But it's not where we tend to want to focus on the front end, and we like to make sure we're sort of critical mass before we spend too many resources on those channels. That's a general idea. There's certain product sets that actually do really well in retail, and we would entertain going there first. But I would say vast majority of what we look at and work on, we're biased towards staying in e-commerce as long as it makes sense.
I like it, Brian. And awesome. So the last question I have is around multiples. So obviously we won't talk about the specific multiple in any specific deal, but part of the attraction to the e-commerce space surely is the multiples. So what multiples are you typically seeing, and how does that differ from the middle market type multiples you are dealing with at Prudential?
Yeah, I think multiples are a funny thing. They're like opinions. Everybody's got one. And I definitely, I worry about, the country club effect of, talking to someone and, him or her telling you I sold my business for 15 times EBITDA. And then everybody thinks their company's worth 15 times EBITDA, because most are not. So, multiples range, very widely. I would say, we see anything from, and we value things based on a multiple of EBITDA. We're not big fans of multiple of revenue. We like cash flow. Cash flow is what pays your bills. So that's a good thing. We tend to see anything from, I would say, 4 times EBITDA up to 10 times. And really what I would say makes the difference as to whether you're 4 times or 10 times is, one is size. As you get bigger, you're going to go get a higher multiple. And then the other part is a lot of these, qualitative factors. If you are 100% on Amazon, if you have a hodgepodge of products that don't really have a brand identity, and you're growing at a, mediocre rate, you're probably, and you have mediocre margins, you're going to be at the lower end of that realm. Now, if you are growing extremely rapidly, you've got a very attractive brand that has a defensible niche or defensible position within a attractive niche of the market, and you're selling on either multiple channels, or your channels are heavy D2C and less reliance on Amazon, and you've got a lot of the other part of it's future growth. Do you have more product line extensions that are very natural product line extensions that are easy to do, and in terms of should be very easily accepted by your existing customer base? That's going to push your multiple up higher to those higher levels that we see. And so that's
how many.
Go ahead.
So how many deals do you look at that are, say, marketed at 10 times EBITDA that are actually worth that, do you think?
2%. I don't know.
Wow.
Not many. We don't tend to play, at that upper end of the multiple range. Part of what we're trying to do is find situations where we're going to bring some value add, and so value add typically means that there's a few of those attributes that aren't fully baked at that point, and they need some help to get there. That being said, I have yet to run into a transaction where there wasn't some level of competition, whether the competition was another buyer or whether there's, just the competition is, the seller not having to do anything because, he or she's making, a lot of money. So you've got to pay, a market multiple for transactions. But we do, from time to time run into people that have inflated expectations. And so, we tend to, just, continue to build a relationship and see if something will morph over time. But unfortunately, we have to be disciplined in what we do to make sure that we can stay in business as well.
Yeah, absolutely. And I think the appeal of what you're doing or the private equity space, I use that term pretty loosely, it seems very attractive. You get capital, you go deploy the capital, you get these huge returns, and everything's happy days. Maybe you sell the business down the line for a much higher multiple. Why do you do what you do?
I love to build small businesses. I mean, that's really what in terms of waking up and being excited about doing something, that's what gets me fired up. I like the people side of these, businesses and putting the pieces together that are needed to help them get to the next level. I unfortunately am not creative enough to come up with these great products, and so I need other people to do that. And then I try to apply, where some of our talents are to help the overall situation grow. And that's what I really find fun.
That's awesome. That's a pretty cool thing to find fun. It's highly profitable too. You don't have to answer this, but I'm curious. As the partners of the business, are you really compensated more on an exit? I've talked to some groups that's how their compensation really operates, or are you paid along the way? If you can talk about that as far as partner compensation and how that works. Not specifically in your case, but as a concept, how do you think about that?
Yeah, I think it comes back to alignment of interests, and you need to have everybody in the boat rowing at the same direction. We put some of our own money into these transactions, and we get the vast majority of the compensation that we're going to make is based on a successful exit. So we all need to get the company heading the right way and growing and get it to position to where it's attractive to where it can be either acquired or it can be attractive to where it's kicking off a lot of distributions and dividends. The interim period, we get a small management fee that's paid to us, but that's barely keeps the lights on. To be honest with you, it's really all about the upside that we're in it for. And I think that's where the fun is, and that's why we think we're really well aligned in terms of interests with everybody.
I like it. Well, this has been a super interesting conversation. Hopefully, the listeners have found it as exciting and enjoyable as I have. I could talk to you all day, but we are coming up to the end of our time here. So, Brien, how can people get in touch with you?
Thank you very much too. I've enjoyed the conversation. Easiest way is probably email. And so it's Brien, and I spell it funny, Brien, at altacrestcapital.com. And then you can also find us on our website at altacrestcapital.com. And that's ALTACRESTCAPITAL.
Excellent. Awesome. Well, yeah, I highly recommend people go to your website and check that out, and definitely reach out to you if they've want to learn more, or if they've got something of interest to talk about, for sure. And maybe just to wrap up, you've talked a little bit about the criteria that you have for investing. Is there anything else that you'd like to highlight here as a potential opportunity if someone is either with their own company or they're talking to a friend? What type of businesses are you guys looking for at Altacrest?
Yeah, we love consumer product companies and really a wide variety of sizes. We can do transactions that are, quite a bit bigger than beyond $10 million. I mean, that's our legacy at Prudential. We did a lot of transactions for companies bigger than that. But we love to learn, and we love to look at companies. We love to talk to entrepreneurs and operators. I would just recommend people to reach out to us, and even if it's not a fit for us, or you're in a different part of your company life cycle and you're not ready to do anything, we love to just begin a conversation. And if it's not a fit for us, we tend to know a number of folks in the industry, and we're happy to make introductions, because that usually turns back around and helps you out in other ways down the line. So
Yeah, absolutely. I love it. Awesome. Well, thanks again, Brien, for coming on Truth About Exits. This has been a great conversation, and I'd love to have you back on after you guys have done some more transactions, and we can talk more about it. Maybe a transaction we work on together even. That'd be great.
That would be great. We'd look forward to it.
Awesome. All right. Thanks, mate. We'll talk again soon.
Take care. Bye.
Thank you for listening to another episode of Truth About Exits. Now, whenever you're ready, here are 3 ways I can help you. If your company is doing between 10 to 50 million plus in revenue, and you want help to plan your perfect exit to achieve the highest value and best deal terms possible, or if you'd like advice on acquiring other companies to continue to grow your company, we can help. Go to truthaboutexits.com/consult. There you'll see a simple form to tell us a little bit more about you, your company, and your goals, and my team and I will take it from there. So go to truthaboutexits.com/consult. The second way I can help is become a guest on our show. If you've had a successful exit, you want to share your story, or if you're actively acquiring other businesses and want to share your criteria with our audience, go to truthaboutexits.com/guest. Let's connect, and I'd love to talk to you. The third way I can help you is one of my favorite things in the entire world is sharing the Truth About Exit stories with other entrepreneurs by speaking at events all over the world. So far, I've had the privilege of speaking at events in the US, Canada, UK, Spain, Germany, Ukraine, Czech Republic, over in Asia, China, Hong Kong, Thailand, and even Australia. If you would like me to speak at your next event, go to truthaboutexits.com/speaker and tell me a little bit more about your event, and we'll go from there. Thanks for listening, and I'll see you on the next episode.